Hi everybody, we're on an episode of The People's Voice, and we have Brenden Lowbridge here. He's the owner of Money Links based in Newcastle, but he does do a bit of work all over Australia. And he's also the Regional Broker of the Year, just awarded, so that's pretty cool to have Brenden on. As always, I've also got Tripp for The People's Voice. But g'day Brenden, how you going?
Really well, Adam. Thanks for having me, Adam and Stephen. Really appreciate the opportunity. Looking forward to the chat.
Awesome, mate. Good to have you here. Good to see you. Well, in case you all don't know, which you won't know, that Brendan's a very good friend of mine, so we're good to have him on here. But it's going to be pretty comfortable. Have a bit of a laugh. We've chewed the fat many a times over the last 2 years of all the events of what's been going on. We're in fairly similar agreement about the government overreach and all that kind of stuff. We're not really going to talk about any of that today, but sometimes we do tend to waffle on. So it's been fun. But
to start off with,
yeah, that's it. So, well, Brenden, why don't you just give us a small introduction about what you do and your business, and then we'll get started from there. We'll just see how we roll on.
Absolutely, thanks. So we're a mortgage brokerage, as you mentioned. We're based in Newcastle, but we cover all around the country, and predominantly, our clients or our ideal clients are trying to, create a level of wealth for themselves through property. Now, we realise that will normally mean a level of debt is needed to be taken on in order to sort of progress their plans and in some cases build a property portfolio. But, the ultimate outcome for us is we want to see people debt-free. And one of our mantras is we want people to live an abundant life and a life full of choices. And unfortunately, as we've seen when you mentioned mandates, it was the people that had the large amount of debt, limited asset base, limited cash reserves that unfortunately were the people that didn't have choices. So that, for us, ultimately is, our why with what we do. And, yes, debt plays a part in that. We realise that too much debt can be obviously can be very can really do a lot of damage to you, but it can be used as a tool done well and can set yourself and your family up. And that's sort of we try and play that advocate for our clients to assist them in doing just that.
Well, looking forward to it. I hope to one day be one of your clients. As a matter of fact, that we've had a bit of a struggles down here down in my Sydney and Campbelltown area with a few things that happen and all that. But one day we'll get there, and definitely going to be using Money Links to help me set my wealth dreams afloat. We're looking forward to that, and that's going to be great. So, all right, Brenden. So, well, a lot's happened. So now we're at the aftermath of the COVID crisis, I guess. Despite the media still really pushing it, and everyone's still. I mean, I had a blood test this morning, and I had to still wear a mask. Who knows why? But I was just going to say, we're in a situation now where New South Wales is hitting some massive debts. Australia is just over $1 trillion worth of debt. It's creating money's been printed crazily, and now we're paying interest on that money, and then we've got interest rates going up and inflation going high, and we're getting figures of inflation, and now talking about hyperinflation and recession. What are your thoughts, mate? And what let's lead into that from that.
I mean, look, you nailed a lot of it in that intro. I mean, we went through the whatever you want to call it, pandemic or whatever you might refer to it, and we had that period of time, and then all of a sudden, due to that happening, it became okay that governments around the world created in the trillions of dollars. I mean, ours is big, but the US I think was $7+ trillion. They're now in debt to the tune of 22 trillion or something along those lines. We're over $1 trillion, which you mentioned. And as you said, when this debt's created, we're not producing anything more. We're not becoming more efficient at doing anything. All we're simply doing is throwing more money, which is essentially a fuel on the fire. And we did that, and told people they didn't have to go to work, but we'll pay them their wage, in fairy dust that's created out of the sky by these central bankers. And then if you read any economics book, they'll teach you in probably one of the first lessons that inflation is simply, the increasing in the money supply. In fact, that was actually the old definition of what inflation was. It was never a box of goods and services that we measured in price. It was actually expansion of the money supply used to be what inflation was. We've expanded the money supply. As a result, we now have the new type of inflation, which is, goods and services increasing. That's now a 21-year record. There's a lot of information that would suggest if we actually did our numbers based on things about 20 to 30 years ago, and we recorded things maybe more accurately, that would probably be more like double, and it would probably be something that maybe wouldn't be a 20-year high, but more like a 40 or 50-year high. So it's definitely unusual times. People are feeling it. The cost of living is rising, and now the Reserve Bank is trying to do what they can to sort of curb that by lifting interest rates, which is really their main tool to do this. What's really interesting is they get together and they say, "Oh, we could have never have foreseen the inflation," but in history all over the world, time and time again, governments create all this money and then you end up with inflation. But yet these experts on millions of dollars a year apparently couldn't foresee that we're going to have inflation when a university economist in year 1 or year 2 of their studies would have told you during the pandemic we were going to see inflation, but these guys apparently couldn't foresee it. So I find that really interesting.
Well, Alan Jones has called for the head of the Reserve Bank, I believe, saying that he should have been able to foresee what's been going on, and he should have raised the interest rates a lot sooner than they did. Do you think that they waited way too long to raise interest rates?
Well, I mean, I probably don't think that we should have had interest rates that low in the first place, right? So there's the argument around, well, they should have increased earlier. I just don't think we should have ever had a manipulated economy built on these low rates for so long. But unfortunately, that's just what the economy's used to. It's what a lot of the, I'd say the Western economies are now used to, is ultra low interest rates for long periods of time. So people like us on this call and everyone else, they gear their lives around that. So then they get trapped in a position where people gear up to borrow because they have to, because the prices of houses are inflated. They take on certain debts maybe within their business and everything else, and so they adjust their lifestyle and play essentially with the rules that they're being given, because that's essentially what the central bank is doing when they push interest rates to obscene lows and manipulate them for so long. It encourages people to borrow and to spend rather than to save. That's what they've done. So whether it was too early or too late that they rose interest rates again, I'd probably argue that they shouldn't have got themselves in this position. But unfortunately, it's what a lot of the central bankers do, and governments like to sort of throw handouts around, and obviously these central banks support them by extending them more and more debt so they can throw the money around.
Do you think people understand the system of interest rates and inflation and buying property? We just came out of very fertile ground, especially for buying property. The property prices are very high, but the interest rates were low. So a lot of people would have jumped in on that. Now we're facing still high property prices coupled with rising inflation and rising interest rates. Do you think people can see that far ahead and see the dangers when setting up a loan?
It's a really good question. Look, I mean, when we go back through that pandemic period, Philip Lowe was out saying that there will be no change in interest rates till 2024. So, I mean, this is, so you've got, I think you said Alan Jones is criticising him because he didn't lift rates soon enough. But then you've got a lot of Australian households that made decisions based on his commentary to say that he wasn't going to lift interest rates till 2024. So there's a lot of people that are now saying, well, he went too early because people made financial decisions on the presumption that those rates were going to stay where they were for 4 years. Now, a lot of people would argue that, when you're signing a 30-year or a 20-year loan, that's not 4 years, but hey, you can make a hell of a big dent on a mortgage within the first 4 years if you can set a budget for yourself and really get ahead. So I think that, people do, on the whole, think about what they can afford, and that's a part of it. But there's been a little bit of misguidance out there. And as well, there's a lot of people, you guys are probably very familiar with this in Sydney, but a lot of people unfortunately have to stretch to buy a home. So they probably have to put themselves in a position that they're probably not overly comfortable with. But if they want to live in any proximity to their work, their kids' schools, their friends and their family, that's the position that they have to put themselves into in many cases. And the alternative solution, renting, is generally not that much more cost effective than buying the home. So they're sort of in a catch-22, and unless they sort of move and go regional and sort of start their life over again, a lot of people see that leveraging probably past their, sort of comfort level and at least owning the asset is still a better outcome than paying rent.
You mentioned going regional. You're in Newcastle. You wouldn't even really consider Newcastle regional at the moment with the housing prices there. Even that's expensive, isn't it?
Newcastle definitely is a lot more expensive than probably like everywhere, I guess, in many cases is. I would say that the cost of living here and the cost of housing is still a lot better than Sydney in the sense that there is still a property in reasonable proximity to the Newcastle CBD that you can buy for around that. The government sort of sets that $650,000 as being a sort of benchmark for the first home buyers, and they'll waive your stamp duty as a first home buyer for that. Obviously, that means nothing in Sydney, but in Newcastle, you could still get into the market, and have a 20 or 30-minute drive into Newcastle, say, and be able to secure a property like that, and still sort of live and work in the CBD. So there's still a level of affordability, but certainly has got more expensive.
It's still a crazy amount of money, though, isn't it?
Well, it is, but the money's just being devalued. This is the thing, is that, all these assets will at some point become crazy, because as they just throw more and more money at these problems, the money becomes devalued. So if anything, I think we'll see it across, we're seeing it across multiple things, rather than just property. The cost of your fuel, the cost of, your electricity bill, the cost of your insurance, everything's becoming more expensive.
And the flip side of that is... sorry, Adam. The flip side of that is you can't keep out of the property market, because if you got $200,000 in the bank, you can't keep that sitting in the bank, because that's just going to get eaten up in inflation.
Absolutely right. Yeah. So it's so the whole idea, I guess, there is and I'm not a financial planner, first, for the listeners, so anything I'm talking about is more general in nature. But the fact of the matter is, in a high inflationary environment, the cash can be eroded. In a hyperinflationary environment, the cash can be eroded in a matter of weeks or months, literally worth not even what, you've seen the examples that were in our lifetime where people in Zimbabwe needed a, $1 trillion note to buy a loaf of bread. So someone that was sitting with a reasonable amount of savings in cash, thinking that they had a reasonable nest egg, you have a government go and mismanage an economy to that degree, and that can be basically gone.
Yeah, wow. Well, I think we should be buying silver and gold. I know that you've spoken to me about buying silver and gold, and Stephen has also been talking to me about buying silver and gold. And then I decided to run for politics, and then all the money that I would have bought silver and gold with just went. Ooh. So I tell you what. Well, I tell you what's worse than hyperinflation is running as a candidate in politics. That's worse than inflation, but it's well worth it, because it's actually a good experience, and you can really make a difference. But back to stamp duty. What about there's two plans at the moment that I think are still being tossed up. There's the 40% government buy-in that Labor was kind of coining, and I believe Dominic Perrottet is also, which is Liberal for state, and he's kind of jumped on that bandwagon. But there's also the one where instead of paying your stamp duty, you can pay a land tax for the rest of your basically life.
Yeah,
what do you?
Right.
I mean, I know, like I'm not a financial guy, but I'd rather just pay a lump sum and pay it out, and then over 30 or 40 years, and then own what I have, than pay a tax for the rest of my life. That's just me. But what do you think?
Yeah. I mean, you have to. The hard part is it hasn't been fully released to be able to model it. I mean, with any of these things, you can probably model how long you're planning to be in the property, and then sort of against the one-off, and there's probably a financial decision there. But if you put that aside for the moment, I agree with you. I mean, you think about even now, you pay rates, and if you're in a reasonable value property now in Sydney or surrounds, your rates are getting right up there now. To drive on a road, you're paying for the pleasure to drive on your road. You're paying for the pleasure to have your car on the road. You've got to, register your car every year. So you literally get up and breathe in this country, and you're getting charged for it. So I think it's another one that'll be added to the list, which will be, a further, call it a land tax or an extension of your rates. People are still paying it. Investors pay it in the way of land tax. Homeowners pay it in the way of rates. And it'll be an extension on that. And, I guess that for them is a way to try and make the property market a little more accessible for people. So the intention, I hope, is pure, but in reality, I think it's going to lead to, people having more expenditure and unfortunately, another bill to Big Brother.
Don't you think if the government, look, to me, if the government buys 40% of your property, and that's taxpayer funded, right? Don't you think that they're just that the builders and the homes will just be raised by 40% within a year anyway? So then if you were buying $1 million house 2 years ago, and then you get this 40% buy-in comes popular with the government kind of idea, don't you think the builders are just going to go, yeah, and then all of a sudden charge $1.4 million for your house because that's a 40% buy-in? Like, to me, it just makes it's like another inflation on top of inflation.
Well, you make another really good point. I mean, that's supply and demand, right? And what I was referring to before was the change in the stamp duty tax. And you're talking about the scheme where the government will sort of co-invest with someone for their first home. And you're right, like all these consistent demand-driven policies where they're going to throw cash at you, they're going to reduce your, overall buy-in cost with your stamp duty, or they're going to partner with you on a property. They're all just additional demand thrown into the mix as far as property is concerned. And I don't. You guys might be more familiar with this than me, but I don't know. I see too many, avenues in government that are looking to try and streamline, sort of the onset of supply. And I think that when you look at guys like Harry Triggerboff, and yes, they're ultra successful billionaires, but one thing they consistently talk about is the red tape they've got to go through. Like he's targeting places where he can go and invest his money and put a lot of people in jobs in the economy just because he can deal with 6 or 12 months worth of red tape instead of 36 months worth of red tape to build a building. And so it's those type of things I think that need to be reviewed in line with what you're saying, Adam, rather than just more and more stimulus on how we can get more and more people competing for the same properties.
Yeah, well,
and they want to own 40% of your property, but are they going to pay 40% of your strata and 40% of your rates and 40% of your water bill and electricity bill and all that sort of thing?
Yeah, it's a good point. What's interesting is you do get to live in all the properties. So, like from a buying perspective, you give away 40% of the upside when the property grows in values, and you've got to partner with the government. So that's one thing. But you live in the whole property, so your mortgage costs would be low. But I'd imagine you're right. You're probably paying the full cost along the way, and that's the offset of you being able to basically occupy the full property, but only own 60% of it. It's an interesting one. I think we'll be busy doing them for first-home buyers, because I look at it now, and you look at the marketplace and where it's going, and even the cost to sort of replace a very basic level, single-level home in our area now is about $450,000, and there's a lot of people that even out as far as the Hunter regions like Maitland and beyond have paid $450,000, $490,000 for a block of land. Add those two together, that's very expensive for someone that, I assume is out in these Hunter regions trying to sort of find affordability. But they're definitely not getting it. Construction's going up, so I imagine that's going to be something that is very popular. I don't know how close we're getting to Klaus Schwab's big plan there, Adam, as far as people not owning things, but it's starting to feel a little bit close to my liking. But I'll leave that up to you guys. You're smarter than me. You can decipher that one for me.
Well, you will own nothing and you will be happy, but really, will that happen? That's the thing with Klaus Schwab. We're not fan. Like everyone knows that I'm not really a fan of the old Schwabby. And I know that they really get burned up when you knock them or when you say anything negative against them. But I mean, it's all happening. Like you can see, like all of a sudden, your government's getting a 40% stake in your property, and then what happens? How do they leverage that over you in the end? And let's face it, they're always going to leverage it over you. So without getting conspiracy theory or anything like that, I just think that, people really, really need to just have a look and just open their eyes a little bit to see, wait a minute, this big industry is saying, and all the advertisers on TV about, oh, guess what? I can buy this $7,000 Gibson guitar because I rent a house now. I'm not going to spend the money on a mortgage, but I'm going to spend $7,000 on this Gibson guitar. Well, you know what I mean? Like, I mean, we've all blown money. We've all been kids. We've all done that kind of thing. But at the end of the day, right, I don't think humans like to own things. That's why we invented fences. That's why we had branded our cattle. That's why we lock our cars. We like to have things that are ours. And I think going against that is going to break us up.
Well, property rights is a huge part of a successful economy because we are self-serving, for us, I think, in our family as humans. And, part of that is, when you want to sort of, have your family prosper, you want to be able to earn and put away more than what you've maybe, you sacrifice more than what you don't consume what you've earned for that year. And then you're able to store something away for yourself and future generations. And if you don't have, sort of strict property ownership and property rights around whatever those things may be, whether it's, we mentioned, savings or gold and silver or land or cattle or whatever that might be. If you don't have, sort of strict rights around that and ways of basically making that legitimised, I think society would fall apart. We look at these places that have gone, to turn to communism and the like, and I don't see any examples in history where it works out for people.
Yeah, I don't see very many happy people there. Well, they pretend to be happy because they get that social ID probably on them, and then they know that if they say anything against anything, that then they're not going to be able to get any sort of food, or they're going to miss the delivery run for that. So, but it's very scary times. I mean, I feel like we're just on a hair trigger. I just feel like at the moment there's a bit of normality. Things are kind of like creeping back, but I just feel like it. And I don't know if everyone else is kind of feeling the same way, but I feel like it could just slide sideways, super quick. So I'm keeping my eyes peeled.
Well, what I found interesting, I don't know you guys have gone through this process yet, but if you want to operate a business, they've just put out the director, well, they haven't just put it out, they had it out for a while, the director ID. Now, I don't know, we could go down the rabbit hole on that, but, my accountant kept saying, Brenden, you've got to do your director ID, you've got to do your director ID. And, they were threatening massive fines in November if everyone didn't download the app, take a photo of your face, take a photo of all your ID and give it all to the government and sort of, I guess, match you and your companies or whatever they're trying to do. And in the end, I sort of thought I'll hold out till November. I'm not sort of just going to go and do it. I'll wait and I'll see, sort of see what it's all about. And I did. And then, I was talking to the accountant about establishing a company this week, and he said, "You can't do that, mate. You haven't done your director ID yet." And I said, "So I can't do it." And it would have been an opportunity that I possibly would have missed out on. So I had to quickly get on, download the MyGov app, take photos of everything, do all these declarations, hold it up in front of my face for 5 seconds, and then ultimately that opened the gate to do that. So you're right, Adam. It's like there's definitely, I think we're in a lot better place for the most part, in comparison to this time last year. But there's still so much, in my belief, there's so much overreach in so many parts of what, the way we live, and so many of these things that have been normalised over the last few years are now just seen as the way that we sort of do things every day. So I don't know what's around the corner, but I do think there's certain things that sort of haven't reversed. They seem to be just going one way, in my opinion.
Well, that's how they do it. They just do it incrementally. You resist and you say, "I don't want to do this," but then they say, "Well, you can't establish a business or whatever." It's just that's the dangerous thing. If all these things happened at once, people would push back, but it's that slow melting pot type of situation where eventually you get to the point, well, if I want to keep moving forward and growing, growing my business and growing, my personal wealth, you kind of have to opt into these things, which is very dangerous. I hadn't even heard the director ID.
Have you been hustled about it,
Adam? I'm not going to no, and does it mean even if you're a small contracting business, you have to have one as well? Do you?
Well, I don't imagine if you're sole trader, you're probably okay because that's you operating personally. It's more obviously if it's a PTY Ltd company, there's a veil of. That's the whole. One of the great things about a company is that it creates separation between the director and the company. That's where the asset protection comes from. So I guess from a government's perspective, they're trying to, whether it's about tax, whether it's about a number of things, and likely it's probably about tax. It's just about them, I guess, understanding who's behind each of these companies, so they can have a lot more transparency over what's happening. And again, it might be good intention, and I absolutely hope it is. But for me, it's just that constant reminder all the time where you just feel that the government is participating in every aspect of your life.
Well, it's good intention for now. It could be good intention. Okay, we're going to get to know these guys. We'll just check them out, make sure that they're okay to run a business and they're not, whatever, bankrupt or insolvent or whatever it is, and they've got a better understanding of you, right? So, yeah, that can be a good thing, and that can protect customers and buyers and consumers and all that kind of stuff. So I get it. But what happens when, as we know and as we've seen, it changes, and then it changes, and then it changes. Just like Stephen was saying, it just creeps on and on and on, and all of a sudden your data's being shared to, globalist institutions that you didn't really want your information to go to. So it's pretty crazy with that, Like once you're signed in, you're signed in. That's it. You can't delete yourself from the system once you're in it.
And do you guys think that maybe on that, like, privacy is not as valued as maybe what it was from future generations? I mean, because I know that I've got people very close to me and they think some of my views are crazy. They say, well, if you're not doing anything wrong, why are you worried? Like, if you're not doing anything wrong, it's like saying, why don't you go to the toilet with the door open? Like, well, because you don't want to. There's certain things that you just want to, you just want to have. And it's about that protection, like you said, because that information can end up elsewhere. But I mean, do you guys have any views around sort of why we've got to, I guess, because a lot of people are happy to hand this stuff over, right? So, I mean, that's why it's happening. I mean, no one that I really talk to is sort of flat out saying they won't do it, or they're getting forced to do it, I guess.
People are so happy to hand over their information as far as I'm concerned. I'm really not that. I mean, I did get the email from the New South Wales service, and I'm just like, they'll ring me. If they need me to sign up or do it, they'll ring me. I'm not really that fussed, you know what I mean? And I'm not a PTY LTD. I'm only a sole trader, so maybe it's still. So sole trading actually got me out of a lot of the overreach from the government. You know what I mean? I just sat down and read the rules every night and kind of like, well, I'm my own boss. Am I really? But I am. And like my boss said to me that I wasn't required to partake in any of the mandates or anything like that. So you just keep working. That's the only thing that saved me, being very small, like a single cell organism. So it was pretty good.
Yeah. That's good. Yeah. You sort of flew under the radar a bit there.
Yeah. So I'm just going to keep trying to fly under the radar, even though I'm doing podcasts and running for politics.
Love it.
Putting your face on the van and getting out there.
Yeah.
That's
Hide in plain sight. Hide in plain sight. That's the best thing. I'll hide right in front of you.
That's exactly right. Exactly. No one will suspect anything.
No, that's it.
So I think we're heading for some rocky times with the economy. I just want to kind of shift to maybe some advice that you can give people moving forward, especially if they want to enter the housing market or maybe increase their holdings. Maybe they already have a family home and they're looking for an investment property. Can you explain something like negative gearing and how that benefits people in terms of investing?
Absolutely, yeah. So, I mean, negative gearing, the best way I describe it is it's like a point in time in which you might own an investment, and then that investment, the cost of it, main cost is normally your interest costs. You've then got maintenance, you've then got property manager fees, etc. If those costs outweigh the income that you're bringing in, then you're essentially making a loss on that property, and then that loss is offset against your taxable income. So a lot of people making a reasonable income see that as the means to an end, because they think it's going to minimise their tax. But we sort of more have a view, and we, when we're talking to people, it's general in nature, but we're sort of saying, would you go out in an investment and deliberately try and lose money? And no one will ever say that that's their intention with an investment. So negative gearing, in the opinion of myself and our team, should always be essentially a byproduct of the journey you're on, and you will, in some cases, get some taxation reward or rebate during the process. But the long-term goal should be buying a great property that has strong capital growth, and at a later stage in life, you've got a strategy where you're going to eliminate that debt and you're going to be living off the income that property will produce. Now, some people, it might be as simple as you have your home, you buy an investment property, and you sell your investment property after 10 years. That enables you enough to pay off your home, do whatever you feel is right with the extra money. Maybe that's put into super, depends on the person's circumstances. But that one strategy has maybe enabled them to get out of debt in 12 to 15 years and have extra surplus money left over, rather than a whole 30-year loan term. So it's little things like that. But negative gearing in itself is essentially the ability to offset some of your tax, but certainly shouldn't be the reason you want to go and invest. And in fact, where we've seen probably some people come to us after they've made decisions like this, they tend to go and buy properties in these out there places, and they want to get a new apartment in a place that's not really hasn't really got a track record of success as far as capital growth, and they've bought it for tax reasons. And it looked great from a tax savings perspective, probably didn't look good from a perspective of why you would buy an investment, and that's the future growth and future returns of that investment.
And what about equity? A lot of people kind of view property that they buy a property and then they need to sell the property to buy the next one. Whereas, in fact, you can actually use the equity of the existing property to get a higher loan to get the second property. How does equity play into all of it?
Absolutely. So if you have an existing property that you own and you say, let's just use some round numbers, the property's worth $1 million and you owe 300,000 on that property, if you can afford to pay back the loan, most banks out there will allow you to release equity up to the 80% level of that property. So in that instance, you've got about $500,000 of what we would consider available equity that you could use, and that could then go and basically play a part in future investments. Now, often people will just need to get out enough to cover the deposit and the stamp duty and the other costs of that investment, and then provided they've got the income to support the secondary loan, they've then got what they need to essentially advance their investment strategy and portfolio. So that's how you see most people. Like, we've got clients with 20 plus properties, and one thing I try and explain to people is the first property is the hardest because you're using your after-tax income to build up enough to get into that property. So it's always the hardest one. After that, you've actually got the market forces helping you, and if you have 5 years worth of capital growth, in particular what we've experienced over the last few years, where some areas properties increased 40%. So you can imagine if you had a property or a couple of properties in that marketplace, you've now probably generated the equivalent of 2 or 3 more deposits in that growth that you've basically received in that marketplace. And provided you've got the income to support it, you can move on. And that's generally the key with investing, is most people that have owned property for a while are now in a position where they've got the equity, but where it becomes more challenging for people that want to invest and continue to invest, it tends to be a story more around their income, because they've got to support their living expenses, they've got to support their own home mortgage, they've got to support, a lot of people today have car loans, credit cards, that's all sort of part of, I guess, in many cases, normal life now. So you've got to be able to support all of those things. If you throw in a partner that maybe looks after the kids and doesn't work, and you're a sole income household, it becomes very hard to then establish to the banks that you've got surplus income to be able to go and support more debt for investing. So it's definitely possible, and a lot of people do it, but we tend to find over time it's more so the ability to prove and demonstrate your income becomes more challenging than showing the equity for the deposits.
Wow. That's where I'm in. And if you throw that into the mix of owning your own small business, then you're really in strife with the banks. That's where it gets really, really hard. Even though you've had positive income for, 15, 20 years, they look at you and go, no chance, buddy. See you later. But anyway, that's why we have mortgage brokers like yourself.
100%. And it's hard because in a business, I understand there's the conflict of, you want to, obviously there's expenses you can claim, there's things you can do, and you can minimise your income and minimise tax. The hard part is that's often conflicting to what the banks want to see. So the banks want to see as much income as you can generate, whether that's profit or wages, and they're willing to accept that. But the conflict often comes where you've got those additional expenses, your accountant's saying, claim these expenses, you're crazy if you don't, because it's going to save you X amount in tax. You make that decision, and that then sticks with you for at least 1 year, but often 2 years with a lot of banks. So it's sometimes those, it's like if I've got clients with aspirations of borrowing money and growing their wealth, I'll say to them, a good accountant is not an accountant that says how low can we get your income because we want your tax as low as possible, although I am a fan of obviously minimising tax where possible. But a good accountant should understand your goals and say, hey, John, I know you want to basically buy an investment property in the next couple of years. Let's have a chat with Brenden and his team, and let's make sure your income's starting to track where it needs to be, and set some goals around how much tax we need to pay in order to unlock that potential. Because anyone would believe that if you own an investment property, I think for a long period of time, that is going to far offset the one-off savings you're going to get from lowering your tax for 1 year. So that's often the conflict that we see smaller businesses in when it comes to sort of weighing up investing in property or minimising tax.
Yeah, 100%. You have to show if you minimise all your tax or maximise all your tax, and then it reduces your income. So then all of a sudden it's like, you could have earned $100,000 income, but you've you've maximised what you have to pay out, your costs, to bring your tax rate down, and then all of a sudden you've shown an income of $30,000 for the year, and then that's not going to get you into your property or into an investment property. So it is. I speak with my accountants about things like that as well, and from your philosophy and talking, and that's what we do. So we always show that you're having an upward tracking income. So that means sometimes that I could get more money back in tax if I really wanted to, but I choose not to because I want to continue to show that I'm making good money. So I choose to pay tax over getting it back.
That's right. That's exactly right. It's not an easy decision for people to make. You've got to be thinking long term for that, but it's definitely the one that we see. If someone calls me and the first thing they say is they've got their own business and they've got a really good accountant, that to me straight away tells me that's going to be a tough one, because what they're really telling me is they don't pay much tax, which then essentially means they're not showing a lot of income. And, there's certainly people that try and get around that with low doc loans and things like that. But I'll tell you that the way that our banks are legislated by the government as well, there's not really much getting around these things. Low doc loans have literally been put in place now for people that are making great income. They really are genuinely making great income. They can't establish that they're making good income through the typical financials and tax returns that a business owner would have. So an example might be they're late on doing their figures, they haven't actually organised their figures, or simply that, we're only newly into a financial year now, but you might be 6 months into a 12-month financial year, and last year's doesn't look great, but you can show that this year's really, really moving along nicely because you've made some great changes, or you've attracted some new clients. So you can't show a 12 months worth of last year's figures, but you certainly might be able to show your bank statements or maybe your BAS, where you can actually show, hey, I've had a really big increase here for 6 months. That's typically where the low doc lenders step in. So we don't have an environment anymore where you could sort of just sign a document and say, I earn this much money, and get yourself a mortgage anymore. You do see some of that in the asset finance, particularly in vehicles. That's why you typically see a lot of people in very small businesses drive Rangers, and so if you ever see people in small business driving flash cars, don't be deceived by that. It's simply just all those old tricks that you could use in traditional mortgages are no longer there, but they are still there in commercial asset finance for vehicles and other things of that nature.
Yeah, 100%. So a low doc loan. Sorry, Stephen, there must be a little bit of a delay there, but 100. What is it? I think with a low doc loan for a vehicle, it's a 20% deposit, and then you sign a statutory declaration saying that you can pay the monthly payments. And that was
many cases no deposit, Adam. Like if you had an ABN running for 2 years, and I don't want anyone to be listening to this encourage them to do it, because it's exactly what you should be doing if you're trying to create wealth. It's more seeing that people are getting in the trap of doing this, and the temptation of a great car is often a hard one to resist. But in reality, that's something that anyone with a business can go and achieve. So in my mind, it's not really a milestone or anything to really be celebrated. But I've got pretty strict views on this. But essentially, it's just outlining to the people here that if you see someone who's driving that car, don't necessarily think that they're doing fantastically financially. There are things that you can do, as Adam mentioned, that can make that happen with relative ease, even if your business is not necessarily doing great.
And with interest rates going up, have you seen a slowdown with your clients? Are a lot of people more hesitant to buy property now?
Look, we definitely did in the outset. So what I found, the rates have gone up 4 times, Stephen. They've gone up, 1.75% over 4 rises. So a very aggressive approach that has been used by the Reserve Bank. We might get into sort of predictions and maybe why they took that path in a second. But for me, it was the first two that shocked people, because you've got to think there's a lot of people that haven't necessarily experienced an interest rate rise. So we actually, a lot of our job was really just to keep people calm, because, when you hear of the way the media gets into things, and, we could go on probably for a whole podcast about the media and the criminals there. But at the end of the day, when the media gets a hold of something, they make it sound like, these rates are going to go from 0.1 where they were at the Reserve Bank to 20%. There's no context. There's no reason why. It's just, selling papers and subscriptions. And unfortunately for our clients, even though most of them are very well educated, they get caught up in that. And so it's our job to basically try and calm them down. So to answer your question, the first 2 months, we definitely noticed that, there was a level of uncertainty, a level of, people being cautious. Since then, I think that people now, surprisingly, when you get to the 3rd and 4th increase, I think the people that think, my household budget can sustain rates where they're likely to end up, and it's a conversation we have with them. And then so there are some people that are using this opportunity now as an opportunity to really buy property, whereas over the last 2 years, they were competing with 9 or 10 other people. Now they can go to an open home and they can actually be the only person there who's seriously looking. So definitely we've noticed a slowdown, but we've noticed that we were impacted more sort of 3 and 4 months ago than we have been in the last 2 months. So we're noticing that there's a certain level of normality coming back now, and we're not having as many sort of, I guess, frantic conversations with people who feel like, this period of time we're in is never going to end.
I love looking at the history of politics, and I'm actually looking at like the Labor Party from the late 80s and early 90s. And one thing I was watching last night was when interest rates were about 17%. Do you see that ever happening again? And do you think how high do you think interest? I know it's a hard question because no one knows, but how high do you think interest rates will go?
I think that, in the 80s and 90s, you're talking about sort of, then you had Keating, who was probably had more, I think, willpower than others we see today. And you could argue that probably we need higher rates and we need a huge reduction in government spending to get the economy back on track. I personally don't think that you've got anyone that I can see in government that's willing to make that call. So if I was a betting man, I'd bet that the rates don't have all that far to go, because I think that if faced with a potential pretty serious recession here in Australia and inflation, so then they've sort of got a problem, because you would generally decrease interest rates to get out of a recession, or to stop the onset of a recession, where you'd increase interest rates as we're doing now to fight inflation. So they could end up in a position where they're actually trying to decide which of the two is the worse of evils. And I personally feel, and I don't know your guys' thoughts on this, but my personal belief is that they will abandon the fight of inflation, and they'll appease people by cutting rates. You're already seeing the Albanese government is talking about other stimulus packages and things that I'm sure you guys know more about than me. But to me, it just seems like a continuation of more stimulus, more cash being thrown around, and I foresee that probably rates will level out. I would imagine at the Reserve Bank level, maybe in the sort of mid to later twos, which is in line with what a few of the banks are saying. And to put that in sort of real terms for anyone that's listening, I think they'll top out personally at the variable rate side at about maybe 4.5%. And that's all. And another thing is, when we talk about rates going up, again, I do believe this is all on the basis that the economy can continue to support the higher rates. If we were to see unemployment start to spike, consumer spending and consumer confidence to drop off a cliff, I personally believe that they may not even get that high. And there's many experts that are already forecasting that we'll likely end up in some sort of economic situation that will even require the need for a reduction in interest rates as early as the first half of next year. So there's already people talking about that. We're only 4 rates in. We've come off what I would consider, we were in an emergency low. Philip Lowe from the RBA said that himself. We've come off an emergency low into what you would consider very, very low interest rates. So we're not even anywhere past very low. And, there's already talk now out there about the first interest rate reduction happening in the first half of next year. So that's my personal view. I could be wrong. Maybe someone in politics will have more balls than that and allow, like Keating said, the recession we had to have, he told everyone point blank, we're going to put the country into recession and try and normalise the economy, and he was willing to do that. But since him, I don't know that really there's been that many bold leaders that are probably willing to make that call. So that's where I think things will go.
So the main issue that you see is government spending. That's the big problem.
Well, your government spending, so that's where a lot of the money is created, because the government's borrowing that money and then obviously throwing it into the economy through the handouts and grants and everything that we've seen. The size of the government obviously is hugely costly, and the debt that they've taken on, there's interest on that as well. So there's multiple layers to the amount of spending, and it's a hard thing to talk about because, and this is right up your guys' alley, but what do you cut? Do you cut, there's so many avenues, and, you don't want to be the person that cuts off anything to disability, to pensioners, to unemployed, to, so it's very hard to decide what avenue you've got to go down. But the reality is the spending's out of control. We're in unprecedented amounts of debt that we're going to have future generations pay back. What does that mean for them? What sort of tax rates are our kids going to be paying? Like, you're already a high income earner in this country. You're paying, the best part of half your salary to the government. What's that going to look like for them? Is that going to be 70, 80%? So I guess I think that it has to happen. I don't know, have the answer on how, and it probably takes someone a lot smarter than me to figure it out. But I just don't know there's someone in there that's willing to make the decision or take action. That's probably more what I'm sort of getting at. So
I've just been also learning about, a little bit more about finance and the economy and banks and RBA and all that kind of stuff. So I don't think not all people, or maybe I was just a daft one, didn't realise that we pay interest. Well, the government pays interest on the money printed.
Yeah, right.
There's
Yeah.
that, like, right. So it's maybe, I don't know. I mean, I know Stephen knows a lot about this. Stephen's also been throwing me some information. That's how I know about it. But I was shocked. I did not realise that the government printed money and then had to pay somebody else interest on the money printed, and then that's what we pay our taxes for, because we have to pay the interest back, and it's all taxpayer, what do you call it, insured.
Yeah. Well, look, I mean, the interesting thing is the government doesn't print the money. The Reserve Bank prints the money and lends it to the government. The government pays them back. So they're meant to be a arm's length institution. It's not a government institution. They're a private institution. So at the end of the day, they're controlling the money supply, and ultimately, it makes you wonder, doesn't it, when the government's in $1 trillion debt to this bank, it sort of gives them an extraordinary amount of power. But as you said, more importantly, it obviously creates that interest bill, which is compounding, because we're not making any dents on the principal. And I don't know if you're familiar with John Adams, but as a company, we just brought John Adams up for the second year in a row, a great economist, to Newcastle to educate our clients in the community. And he's looking at all the budgets, state and federal, and he doesn't see any plans to make any sort of headwind into paying back the level of debt that's out there at the moment. So it's probably here to continue for a while.
Wow.
Well, it's a system that can never work, because if you're lending $100, like to put it into simplistic terms, if you're lending $100 to someone that doesn't have that money and you're charging 5%, that 5% doesn't exist. So you're always going to be in debt.
Yeah, you're borrowing 105 next time to pay back 110, and so on and so forth.
Yeah.
Wow. I mean, that's complicated
that's what
stuff.
We've seen. Yeah. We've seen it as well. We've seen it in countries like Tanzania and other countries during the lockdowns who didn't want to participate in certain things, and and so that some of the control, unfortunately, through the IMF. The IMF was like the central bank of central banks, and they went around to these countries, and these are relatively poor countries, and these numbers off memory, I can't remember the articles exactly because it was a while ago now, but these were in the orders of billions of dollars, and they're saying, hey, just lock down your country. Lock down your country, tell your people that they don't run their business, don't do this, and we'll extend you this loan of billions of dollars. Now, a lot of these countries, as you said, Stephen, never had a chance in hell to repay, principal on these sort of repayments. But these are the things that were happening, at that time, and continue to happen. And like you said, it leaves. I think a lot of countries in a pretty precarious position if they're sort of. They owe that much. I mean, look at is it Sri Lanka? I believe that was it Sri Lanka that just defaulted on their debt. The place is a wreck. So they can't import. They're a nation that imports predominantly and doesn't export a lot. So they rely they have relied on basically being able to borrow money to bring items into the country. And so now you can't get fuel over there. You can't get food. The place is a complete disaster.
Wow. And I could imagine that, luckily enough, Australia's, resource rich, and we can still sell all our resources to obviously make some sort of money back. But it gets to a point where the resources we have and then the money we borrowed with the compounding interest, like anybody, it's only as much as you can pay back. Like just with a tradesman or a nurse or a doctor working to pay off a mortgage. Same with a country; it's only as good as it can repay. So if our debt gets too big and the interest is too high, what happens then? It's not long before we're Sri Lanka, isn't it?
That's right. Yeah, exactly. I mean, there has to be a point, I imagine, and I hope that the policymakers know this point. But it has to be a point where you think that you would sort of start thinking about the budget more. But again, I just don't know that. That looks to be something that is being really considered closely.
Now, how can people follow you or find you if they want to get in touch with you, if they're looking to
learn for sure
about what you do?
Absolutely. So to get in contact, probably easiest and most direct way would be on Instagram if you want to follow Money Links, so MONEY space links, LINKS. follow us there. My email is Brenden with an EN at moneylinks.com.au, and you can email me directly. And happy to have a chat with anyone about this sort of stuff. I'm passionate about it, and I really appreciate you guys having the chat today.
Well, Brenden, thanks for coming on, mate, and I'll speak to you again soon. I mean, I love chatting with you and talking to you as always, and it was really good that you could give us some of your time. If things change, or if we have some more interest rate rises and stuff like that, and you start seeing something, give us a contact, and we'll maybe be able to get you back on again. And talk about it, because it's a forever changing environment. So good to have you on, and I guess we can end it there. Speak it soon.
Thanks, Adam. Thanks, Stephen. See you guys.